So Flanders has the Leftorium up and running, and he started to engage in purchase and sale transactions during January 2009. He needs your help to account for these transactions, and then he'd like to produce financial statements. So we're going to start with transactions related to the purchase of inventory. One thing to note with purchases is that we want to have the true cost paid for the items in inventory on a per unit basis. So transaction 1 says that we purchased 1,000 pairs of scissors for $5 a piece with terms 210 net 30. These terms mean that we're entitled to a 2% discount if we pay within 10 days, otherwise we have to pay within 30 days. Although we could take the discount, it isn't certain that we will. So when we record the transaction, we ignore the discount initially, and we debit inventory for the number of units purchased times the purchase price, in this case $5,000, and we'll credit accounts payable for the same $5,000 to reflect this obligation to pay for the items in the future. Now, transaction 2 says that we paid some shipping costs related to our purchase from transaction 1. Since we have costs flow to inventory on the purchases side, what we're going to do is we're going to increase inventory by debiting inventory for the $500 purchase. So we're basically putting the cost of the shipping into our inventory account. And we have this being paid for with cash, so we're going to credit cash for $500. And then finally, transaction 3 says that we paid our bill from transaction 1 on January 8th, which means that we are entitled to the discount. Instead of paying $5,000, we're going to take 2% off, so we're only going to end up having to pay $4,900, which is going to be our credit to cash, in this case for $4,900. Now, this means that we got a discount of $100, and so we have all costs flowed to inventory on the purchases side. So what we're going to do is we're going to actually reduce the amount that we have in inventory for $100. And now we had initially credited accounts payable for $5,000, but that obligation is no longer there. So we need to completely get rid of that obligation by having a debit to accounts payable for $5,000. Now, one thing that's important to do right now is think about how much did we pay for each pair of these left-handed scissors. Now we know, and one way to do this is to actually take a look at the T account for inventory. So we know that we had initially paid $5,000 each for these 100 or 1,000 pairs of left-handed scissors. We also increased inventory by $500 to pay shipping, but then we got a little bit of a discount by paying early. And so in inventory for these 1,000 pairs of left-handed scissors, we have a total cost of $5,400. And so what this means is that each of these items in our accounting records has cost us $5.40. And this is actually going to end up being important when we start selling items. Okay. Now we're going to go through some transactions related to sales. And sales are a little bit different than purchases in that we separately track extras like shipping costs, returns, and discounts in separate accounts. Sales returns and allowances and sales discounts are going to be two contra revenue accounts that come up that impact the presentation of sales on the income statement. We'll see this when we take a look at the financial statements later. So transaction 4 says that we sold 500 pairs of left-handed scissors to Mr. Burns for $15 a piece with terms 110 net 30. So that means that Mr. Burns will be able to take a discount of 1% if he pays within 10 days, otherwise he needs to pay within 30. Now each sales transaction is going to have two journal entries. I call them the ins and the outs. And each piece is going to have an income statement component and a balance sheet component to it, with the ins talking about what is coming into us and the outs piece talking about what we gave up. The ins are always going to end up being presented at the number of units times the selling price. Since we sold 500 pairs of scissors at $15 a piece, we will debit accounts receivable for $7,500, and then we'll end up crediting sales revenue for that same $7,500. So note that since Mr. Burns could take the discount, but we don't know if he will or not, we're recording this transaction at gross amounts. Also note that the debit to accounts receivable is our balance sheet component of things, and our credit to sales revenue is our income statement component of things. The outs are always presented at the number of units times the cost of the items. Since we sold 500 pairs of scissors, and we know from our previous exercise that each of the units cost us $5.40 in total, we're going to end up debiting cost of goods sold for $500 times 540, or $2,700, and we'll credit inventory for that same $2,700, showing that we don't have the items anymore. So just to refresh, cost of goods sold is our income statement component, placing the expense of these items on the income statement, and the credit to inventory is our balance sheet component, showing that we don't have those items anymore. Now, transaction 5 says that Mr. Burns returned some of the scissors that he bought on January 15th. And so because of this return, we need to undo the sale that we had initially recorded by recording what I call the anti-ins and the anti-outs. Now let's start with the anti-outs because it's pretty simple. We're basically just going to undo the outs piece of our previous transaction by debiting inventory, because we've got these items back now, for 500 times the cost of the items, or pardon me, 100 items times the cost of $5.40. So we're going to debit inventory for 540, and we're going to undo the cost of goods sold entry by having a credit of 540 to cost of goods sold. Now the anti-ins are a little different, because we want to separately track things like returns because they're important to managers who are trying to run their business. So we're going to actually undo the accounts receivable transaction for these 100 items that were returned through a credit to accounts receivable for $1,500. But instead of outright debiting sales revenue, we're going to track these returns a little bit differently by actually debiting a contra revenue account instead, known as sales returns and allowances for our $1,500. So you're never going to see an outright debit to sales revenue. Instead, if somebody returns something, we're going to separately track it in a sales returns and allowances account so we can see the amount of items that are ending up being returned by our customers. Now, transaction 6 deals with the receipt of payments from a customer. Mr. Burns does pay in enough time to take advantage of the discount, but since we're accounting for a sale, we're going to use another contra revenue account called sales discounts to capture this discount. So because Mr. Burns paid within 10 days, he's entitled to take a 1% discount. So when we think about how much Mr. Burns is going to pay, we're going to only receive cash of $5,940 after the 1% discount. Mr. Burns doesn't have an obligation to pay us anything anymore, so we're going to credit accounts receivable for the amount that is still outstanding for the items that he chose not to return. And then we use this separate contra revenue account called sales discounts to separately track the amount of discounts that we provided to a customer, because again, this is just something that might be of interest to managers who are trying to run their business.